20 facts about VA loans you didn't know. Fact number 1. VA loans are not loans made by the Department of Veteran Affairs or the VA. They are loans made by banks, credit unions, mortgage companies, and other financial institutions which are guaranteed by the VA. The VA guarantees these financiers up to 25% of the loan amount. Fact number 2. VA loans are available for veterans who were discharged from service, active duty service members who've served 90 continuous days, National Guard, and reservists who meet certain criteria. Surviving spouses of certain deceased veterans may also be eligible. Fact number 3. VA guidelines don't impose a minimum FICO score, but lenders who make VA loans do. Some go down as low as 500, but the majority appear to require at least a 620 score. VA loans may be made for veterans who have a history of non-traditional credit but have no FICO score at all. Fact number 4. There are no VA loan limits irrespective of county. The amount you can borrow is only limited by your residual income and debt ratio, as well as appraised value. Loan limits do apply, however, to veterans who presently have a VA loan on one property and seek to purchase another one using their remaining VA entitlement. Fact number 5. The VA home loan benefit never expires and it can be used multiple times in a veteran's lifetime. Fact number 6. VA loans have no down payment requirements or mortgage insurance, but the VA does collect an upfront guarantee fee, also known as a funding fee, as a percentage of the loan amount. The funding is higher for repeat users of the VA benefit than for first-time users. It is waived for veterans who have a disability rating. Fact number 7. VA home loans can be used to buy a single-family home, 2 to 4 unit multifamily home, a townhome or condominium unit in a VA-approved project, build a home, simultaneously purchase and improve a home by installing energy-related features or making energy-efficient improvements, buy a manufactured home and/or lot. Fact number 8. The maximum loan amount a veteran can borrow with a VA loan is limited by 3 factors. Firstly, you cannot borrow more than you can reasonably repay, taking into account your income and present debts. The debt-to-income ratio calculated by your lender will limit your loan amount. Secondly, your VA loan amount is limited by the VA residual income requirement. Residual income means monthly leftover income after expenses and obligations, such as federal and state taxes, maintenance of the home, child support, child care expenses, and consumer debts, such as credit card and auto payments, etc. Thirdly, you cannot borrow more than the appraised value of the home you're purchasing. If you're in contract to purchase a home for $350,000, and the VA appraisal comes in short at, say, $330,000, you can only borrow $330,000 plus the VA funding fee if applicable. Fact number 9. There are 2 ways a VA loan can be underwritten by the lender. First, automated underwriting system, known as AUS. Second, manual underwriting. When underwritten through an AUS, the credit, income, asset, and other data are electronically input to an online risk assessment portal known as DU or LP. If the feedback from this portal is approved, then most of the work done by the physical underwriter, a real person, involves making sure the data that was input was accurate and corroborated by paper documents. If the AUS recommendation is refer instead of approve, your VA loan application can be referred to a real person, an underwriter who manually reviews the file for strengths and weaknesses. When underwritten in this way, stricter debt ratio and credit standards apply. This usually means documenting everything more extensively. A loan that's not approved through an AUS could in fact be approved by means of a manual underwrite as long as some compensating factors are met. The VA has given guidance to the lender's underwriter on which factors can be considered compensating factors that offset weaknesses in the loan application. Fact number 10. In order to be approved for a VA loan, the veteran must have sufficient entitlement from the VA, as indicated on a Certificate of Eligibility, COE, satisfactory credit, and sufficient income to repay the VA loan and other existing debts. Fact number 11. VA loans offer some of the most lenient underwriting guidelines when it comes to borrowers who've experienced foreclosure, bankruptcy, or short sale. The veteran can qualify for a VA loan just 2 years after foreclosure, Chapter 7 bankruptcy, or short sale, also known as pre-foreclosure sale. Exceptions can be made in each case to shorten the waiting period. Borrowers who are still making payments on a Chapter 13 bankruptcy repayment plan can obtain a VA loan if 12 timely payments have been made with court trustee approval even before the Chapter 13 bankruptcy is discharged. Fact number 12. VA loans can be funded for veteran and spouse, veteran and another veteran that's not a spouse, and veteran and non-veteran. In the case of a non-veteran co-signing on a veteran's VA loan, the VA guarantee is cut in half, thus making a 12.5% down payment necessary. Fact number 13. A veteran who has an existing VA loan can get a second VA loan, so he or she has 2 VA loans at the same time. This is possible because of what's known as second-tier entitlement, which every veteran has. Fact number 14. Veterans who don't presently have a VA loan are not subject to a loan limit. Veterans, however, who have an existing VA loan outstanding are subject to loan limits based on the guarantee limit in the county that the next home is being purchased in. Fact number 15. VA loans can be used not only to purchase a home, but to refinance one. There are 4 types of VA refinance. 1. Refinance from a non-VA loan, such as FHA or conventional loan, to a VA loan. 2. Refinance from an existing VA loan to a new VA loan without credit qualifying and without an appraisal, known as an IRRRL. 3. Refinance from an existing VA loan to a new VA loan with credit qualifying and a new appraisal, with or without cash. 4. Refinance renovation loan. A veteran can borrow money to remodel or renovate an existing home based on future appraised value. Fact number 16. IRRRL loans made to refinance VA loans that are 30 days or more past due must be submitted to the Department of VA for prior approval underwriting. The underwriter must have concluded that the circumstances that caused the delinquency have been corrected and the veteran can successfully maintain the new loan. Fact number 17. A veteran who has income from a second job, has had that job for at least 1 year but less than 2 years, can use that income to offset debts of 10 to 24 months remaining duration, dollar for dollar. Fact number 18. In community property states such as California, Louisiana, Wisconsin, etc., the debt obligations of a veteran's spouse must be considered in the qualifying debt ratios, even if that spouse doesn't go on the VA loan with the veteran. Fact number 19. For an active duty service member, the non-taxable portion of his or her income, namely BAH and BAS, can be grossed up to 125% of the amount listed on their pay stub, also known as a leave-in earnings statement. This increases their buying power. Fact number 20. VA loans can be used to acquire a vacant lot and build a home all in one financing step. This is known as a one-time close construction loan.